if I think about my dollar forecasting framework, there's sort of two main variables that we have historically put the most weight on. One is a global growth variable. It tends to be the case that when global growth is strong, the dollar is not doing too well. When global growth is weak, the dollar tends to do very well. So that's a variable that historically has been very important, arguably been the most important variable for dollar cycles, right? Second variable everybody knows about is sort of the Fed variable, right? Okay, if the Fed gets very dovish, it impacts the dollar. We saw that in September last year, right? When they cut 50 basis points, the dollar had a move based on that, right? So what's different about 2025 is that we have this kind of structural asset allocation theme. And I think it's really interesting how persistent that theme has been in the last 5 months, right? It doesn't follow the cycles of the other assets. It's an independent factor. I think we can say without blinking that we've been doing a pretty good job of embedding that factor in our dollar forecast for many months now, since March at least. And we will continue to do so, right? But how much weight do we put on that? Given that a number of players have already moved, we probably have to put a little bit less weight on that now compared to how much weight we would put in April. So it doesn't mean that the factor has gone away or is reversed. And positioning is a very tricky thing, right? So it might be enormous in hedge funds, it might be very big in CTA space, right? But there are other spaces where they've not moved yet. So position is kind of a really tricky thing. But I think it's still a dollar negative, but a less dollar negative than it was a couple of months ago, right? So it is very important what happens with the cyclical signals. So we have a very interesting situation here where the September meeting is kind of like crunch time for the Fed. The Fed will have to make a stand. Are they going to continue to worry about realized inflation, tariffs feeding into prices for a couple of months? Or are they going to say consumption is really looking soft in the U.S. economy? The U.S. economy is eventually so driven by consumption that we have to respond to that. September meeting is close to 50-50 priced, right? So if you get that right, you're probably going to have a good chance of getting the next couple of months of dollar trading right, because I think the cyclical dimension is going to be more important now than it was. But don't forget the first dimension, which is the global growth. And this is kind of what we're starting to see very recently, right? That there's actually some patterns in the market that smells like investors are getting more optimistic about global growth, right? So we've had lots of concerns about, oh, Europe is going to be horrible. It's going to be a multi-year recession. They can't handle the trade tension with the United States. They have structural issues and so forth. And guess what? The PMIs are already bouncing. Guess what? The ECB is going on a break. They're stopping the cutting cycle, right? So even in China, I would say the cycle is actually looking like it's turning better. So the global growth dimension is actually getting interesting. You could have a situation where even if the sort of asset allocation factor has had the most juice in April and May, and now it's there, but not as forceful. But you can have a big dollar move if you have a combination of the global growth dynamic looks a little bit better and the Fed cutting, like quite a divergence in signals. So there's a lot of moving parts in the dollar outlook. And I think from a trend basis, the dollar still, in a medium-term sense, looks like we have downside skew. And I would say that even if it's true that there's some of these tactical positioning metrics that looks like people are very on board with the dollar trade, but when you've had a 10-year trend, I think it's one of those situations, do you focus on the tactical positioning? Or do you say there's some kind of structural position that's going to take a lot longer to unwind itself? And I think our framework is one where we do put more emphasis on these structural shifts than we would normally do. Normally we say, oh, we have to respect the tactical signals, but I think there's a more complicated situation at play here.